Waiting for that key inflation data that could impact the markets along with earnings. So many things to watch for. When the January Consumer Price Index comes out, it'll be 8:30 a.m. Eastern Time. We're expecting a 7.3 rise year over year. That would mark actually the highest inflation rate that we have seen in 40 years. That is significant, folks. Joining me now, ERShares CEO Joel Shulman. Also joining the conversation all along, Wall Street Journal Assistant Editorial Page Editor James Freeman, and Strategic Wealth Partners President and CEO Mark Tepper. Gentlemen, it's good to be with all of you. Joel, I'm going to go ahead and start with you. Talk about the markets this morning.
Sure.
As I said, we are searching for some direction here. So many things to think about. What's top of mind for you this morning?
Well, I mean, we're seeing a very interesting market. When you have the FAANGs, which are arguably the most closely monitored securities on the planet, on the one hand, Netflix and Facebook disappointing a great deal and dropping 20%, and then you have Amazon going up 10+%, Google doing well. It sets the stage that it's a very difficult market to predict. And so what we're seeing is a wide disparity in terms of the performance of many of these stocks. We're seeing probably more stocks going up or down 20+% than we've seen in a very long time. And so you're seeing some surprises. You mentioned Disney and Uber this morning, strong news. And then we're seeing some other stocks, even some of the high flyers are up 20+% in after hours.
Can we talk about these inflation numbers that we're expecting? Because, I mean, consumers across the board are worried about prices. It's impacting the bottom line when it comes to their budgets and figuring things out at home. And I've been saying for the longest time, there is going to be a tipping point where there will be a chilling effect when these prices go up, and you're going to see it be reflected in earnings. Now, it's not going to be in the reports we're hearing necessarily right now, but 7.3%, a 40-year high, that is substantial.
Yeah, absolutely. And there are three things really driving it. You've got energy prices, you've got, of course, labor prices, and you've got food prices. Labor prices, once it's in, it becomes a cost push scenario where it goes up and up and up. Energy, too, we're kind of seeing, particularly with geopolitical risk, it's falling, it's rising and falling in energy prices. Some of it's, much of it's hitting companies' bottom line, particularly in the labor side. We're seeing financials, hurt badly, in this quarter's earnings, where we're seeing top line revenues, doing well, but then SG&A costs are rising faster than the revenues, and as a result, the bottom line is being hurt.
Right.
On the other hand, we're seeing some tech companies that are able to expand their margins.
Okay, switching from tech for a moment, since we're talking about consumer, I want to stay there because Pepsi just reported it's a double beat. Obviously, Pepsi has a wide range of consumer products that we all see on our store shelves. And so you look at a company like this and say somehow, yes, costs are going up, but somehow they're managing here. Obviously, the demand is still out there, and we are talking about consumer products at a lower price point in general. Talk about, the split that we might see within the economy with companies focusing on high-end things, seeing higher price increases, and then you've got your essentials. Investors need to think about it that way as well.
Yeah, you're right. Consumer products, I mean, they're slow and steady. You're throwing off cash flow. It's a safe place to be in these markets, particularly as the 10-year is approaching the 2%. That 2% is a very strong psychological level. We were 1.97 the other day, then it dropped to 1.93. When it hits 2%, that's going to be a trigger. Is it going to happen today, tomorrow? Maybe not, but it's going to happen soon. And as you mentioned, in a few minutes, we're going to hear the CPI numbers. They're going to come in hot, particularly on those three variables we're looking at. There are many companies that are not able to pass along the costs. And if they can't pass along the costs, their margins are going to be squeezed. Yeah. So in this market, investors want to look at those companies that can pass along costs. Some can actually gain because they don't have the labor costs that have these difficulties.
Yeah, as we mentioned, there's other big companies reporting as well. So we've got Twitter. We just heard from Pepsi. We've got Coca-Cola, Kellogg's. They're all going to give us reports on the fourth quarter. Disney shares were shares that jumped in pre-market trading after their big earnings double beat, where the House of the House of Mouse reported 11.8 million new Disney Plus subscribers, bringing those subscribers to 129.8 million. Stocks that you particularly like right now for your portfolio?
Well, so we like NVIDIA. It's a solid company for 5-6 years. It's significantly outperformed the market. What's interesting about this market, we saw the large tech sell-off in January. Many of these stocks dropped 20-30%. They're down 50, 60, some cases 70% plus, from their highs. Mark just mentioned that Netflix, has been beaten up. And some of these stocks, they got beaten up, in the last month, and they're now good bargains. And so when people look at things, they just sell because it's a high PE. They've got to factor in the growth. So in the case of NVIDIA, they're growing top line, the revenues. And this is not a new company. This is the company's been around 20, 30 years. They've been growing revenues, 60 to 70% per year. And the bottom line, they're growing by over 100%, like 115%. And that's because they're able to control the costs. To your earlier point about which of these companies control costs, you've got some tech companies that are implementing AI and other methodologies, and technology to expand the margins, and so that's really exciting in these markets where they've been beaten up and they're down. In the case of NVIDIA, more than 30% from their highs. The other stock we like is Upstart. Now, this is a stock many people know it's an AI cloud-based lending platform. They're growing by 200%. Now, these are both stocks. We just got into Upstart earlier this week based on some screens. And what we found was that this is a stock that's down 75%. They're down 30% last month. They're growing revenues 200% per month, and they're profitable. So unlike many other fintech companies, these guys are profitable. They're throwing off around $82 million in revenue. Profits. And so what you see is on a price earnings, and this is a key point, price earnings to growth adjusted basis. So many people look at the PEG ratio. You've got some real bargains here. This thing's off 75% from their highs. They were a $400 stock. Then they dropped 100, or a little less than 100. The other day, I guess yesterday, they popped for about 10+%.
Okay, so you're looking for opportunity there.
Here.
Yeah.
Yeah, we think there's some opportunities here, yes.
Okay, NVIDIA and Upstart. Joel Shulman, ERShares CEO, great to see you this morning. Thank you so much for your time, sir.
Thank you.